Welcome back to the Williams Real Estate channel. Today we are discussing the fallout from the budget and the updates from what we saw over the last few weeks. Starting off with negative gearing. There has been negative gearing obviously being removed from being able to negative gear a established property. You can still negative gear a new property, so a new off the plan apartment and or a house and land package. We suggest not doing that anyway. Negative gearing was never a strategy we look to go down. We stick to high yielding properties between 6 to 8%, because the key is to run your portfolio like you would run a business. You want more money coming in than going out. And negative gearing was an added perks when you're first buying it. The first couple of properties, they may have a bit of negative cash flow, but after 1, 2, 3 years, they all convert positive, even with the rates higher. And that's the aim of the game. You want to keep the portfolio cash flowing, so then the bank will continue to lend you more money and keep growing and compounding and buying more real estate and building a long-term sustainable portfolio. The people that I find getting stuck get conned by the blue chip bandits or the spruikers that push the whole new and off the plan apartments or house and land packages, who are getting kickbacks from the developer, and they dress it up saying, oh, it's all shiny, it's all new, you get all the negative gearing. Well, guess what? If you go down that route, you'll be like 99% of investors who get stuck at one or two. Negative gearing is not a strategy. It's just an incentive to push buyers into certain markets. And now they're looking to push investors into the new property space. So new and off the plan apartments and house and land packages. We don't do it. Why? Because it's just like when you buy a brand new car. You'll pay a premium. It'll lose value initially. Typically, buying new and off the plan apartments or house and land packages, they only stack up for a developer to develop that type of stock towards the tail end of a boom. So you're already getting into the wrong market if a developer's releasing stock onto the market. And what you find is that towards the tail end of the boom, when these types of projects get off the ground and become feasible, there's a lot of developers in the space. We're seeing it all on the Gold Coast and around Queensland and Brisbane and outskirts of Perth, where they're building like mad because the prices have shot up over recent years. So it makes sense to develop and create more stock, more supply, which the developers then create that oversupply scenario we see at the tail end of the boom prior to the downturn, when there's a release of stock and an oversupply scenario, which is now getting created in the likes of Brisbane, Gold Coast, parts of Adelaide, Perth, and even in Darwin. We don't enter into the overheated, stupid markets towards the tail end, because you buy the future growth. You don't buy what has been historically. So we get into the slow, suppressed markets in the likes of Sydney, Melbourne today, where the price point is at least half, if not a third of the intrinsic value. And then that's when you can get in prior to the coming growth cycle, rather than getting in at the final stage of the cycle and rush in with all the FOMO and buy something new. That's when you will end up holding an asset for a good 10 plus years with no growth and even in negative equity. So when you hear the people say don't buy an apartment, they don't grow in value, 9 times out of 10, they've gone and bought a new and or off the plan apartment, peak market, bull run, booming, FOMO, stupid money's coming in, oversupply scenario hits. Developers, when they build these, they don't just release all on one at once, because they know it will drop the market. They slowly drip feed it to the market. But when there's a lot of developers doing the same, and eventually they need to push the stock to move it off their books, they'll release it. And then towards the tail end, when the market turns, then there's lots of supply and not enough buyers, prices go down. So don't get caught on the wrong side. Negative gearing is not a strategy we don't care about it. And the fact that they're getting rid of it now is just disincentivizing the average investor. So there'll be less rental properties on the market. There's ever-growing demand in Australia. So less supply of anything and an ever-growing demand means prices will go up. It's classic supply and demand. So we'll see rents rise over the coming years, which those higher rents will ultimately get capitalized into higher prices. So as an example, if you were looking to go negative gear, and what does it all mean? If your rental income was, say, 30 grand a year and your expenses were 50, you would have a $20,000 loss. Hypothetically, if you had a personal income of 200 grand, you could reduce your personal income down to 180. Therefore, you would have approximately 8,200 in savings. So the problem is you have to spend that money. You have to run a portfolio in a negative position. You already spent an extra 20 grand to save a little bit on tax. I would rather earn 20 grand and pay a little bit of tax. So then the banks will keep lending you more money, so you keep borrowing more, so you can keep buying more real estate and keep growing. So we don't care about negative gearing. It's only going to inflame the rental market, which is going to push up yields, which is ultimately going to increase value of real estate of the established stock. So that's negative gearing. The next thing that they've chopped out is the capital gains discount gone. This is a little bit more annoying, although it's already pivoted. The way I am looking at my own portfolio is not looking to sell as much of the stock as I initially intended. I'll probably keep more of it now. If it doesn't make sense to sell an asset because you're going to be hit with a major tax bill, then just keep it. Refinance, draw the equity, and keep carrying on. So the old method, 50% discount, if you had a capital gain, you minus the losses, you times that by 50 to give you the discount. So you only get charged tax on half of your gain. Now you take the sale price, you minus the inflation adjusted cost base, minus the capital losses, times your marginal tax rate, which is now a minimum of 30%. And selling most assets will go well above 30%. So you end up in the top tax bracket. So you're going to hit a decent amount of tax bill. It is confusing. Speak to your accountant on how to understand how to calculate it. And it all kicks in as of July 1st of July 27. So those that have a property to date already purchased, you can use the old method up until the 1st of July 27, and then from 1st of July 27 and on, that's when the new index model will kick in. Third change is residential property being banned in self-managed super funds. So this is all residential property. So now you can still buy commercial, which is industrial, retail, office space, but anything residential, you can no longer borrow money to put that into your super. This has been a deal done between Labor and the Greens, and this is unfortunate because I guess people that we were helping a lot were struggling to get the borrowing power in personal name or trust structures or company structures. So therefore they looked to put a property or two into their super as they had decent balances. Now they've got rid of that. So there is a mandate, the 10th of August 2026, to have a signed contract. So you can still do it. At this stage, you need your self-managed super fund set up, you need your bank account set up, and you also need a bare trust drafted, ready to go. If you don't have all those three, forget about it. You need to have it set up. But if you got it set up and you're ready to go, we can make it work. We just need to get your finances in line, but we can get you a deal in the next few weeks before the 10th of August. But time is ticking. So it's too late to now try and set it all up. It takes a good 2 or 3 months to set it all up, and you need ATO approval. So they've cut that off. But if everyone who has it set up and if you've got capacity to ready to go, you can still buy a residential property. But the 10th of August 26 is the cutoff. Again, this is going to reduce rental stock into an already tight rental market. There's across the board, there's less than 1% vacancy rates across the country as they've continued to import more people. That's soaked up all the rental stock, and now they're disincentivizing more rental supply by way of firstly negative gearing, and then the CGT tax discount being removed, and now the removal of residential properties in self-managed super fund. This is all going to reduce rental supply. So again, there's going to be higher rents on the horizon. Brace yourselves, tenants. And they've even gone that far to put CGT on personal items such as collectibles are now subject to CGT. See, cars, classic cars, which go up in value. Boats, they don't really go up in value unless if you're buying a low price point, and yeah, you always lose money on boats. But cars, you can make money on cars, artwork, jewelry, antiques, furniture, electrical goods, household items, coins, medallions, they're even going as far as fucking postage stamps. Albo's lost it. I don't think he ever had it, but he's definitely lost it and he's losing it. I don't know who would support this bloke, but anyway. So yeah, be sure to not sell any of this stuff because Albo is coming knocking. He's run out of money. It's a tax grab. It's by no means helping any younger people get in the market or any of that bullshit he drums up. He's just running out of money, spending too much money on the NDIS and wind turbines and solar panels and shit. So he's trying to find it from anywhere and everywhere. So don't sell your postage stamps. Oh, fuck me. Recycle equity. This is by no means financial advice, but this is my story. And this is what I do. We refinance equity out of portfolio. We revalue our properties. We then refinance the loans to draw equity, not only to reinvest into more deals, but we can also use that equity to supplement your lifestyle. Use it to buy a boat, go on a holiday, take time off work, start a business, whatever. 5-6% interest to the bank is a lot less than 30, 40, 50% tax to the ATO. The money has to go somewhere. So it's either more money to the bank or more money to the ATO. And you'll find most big, large property investors use the rental income to service the holding cost, interest, holding cost, maintenance, upkeep, insurance, rates, etc. And they use the equity to live off because it's not taxed. You can't tax debt. It's an unrealized gain. So you can hold on to all your real estate, never sell it because otherwise you get charged tax on that. Don't use, I guess, the rental income, otherwise you get charged tax. But use rental income to pay for the holding costs and then draw equity. Not only reinvest, keep buying more real estate, but you can use it to supplement your lifestyle and live off. And then over time, property inflation will continue to compound the growth of your portfolio 7 to 8% per year, and that same property inflation will continue to devalue the debt over time. So if you've got $1 million worth of debt today, in 10 years' time, the value of that $1 million will be worth 250,000. So it takes a bit to get your head around, but over time, once you invest for a solid 10, 15 years, you'll see your portfolio continue to compound and grow. And once you're sitting on 5-10 million bucks worth of real estate, compounding at 7 to 8% a year, you'll be making a solid 5, 6, 7, 800,000 a year growth. If you're tapping into 100, 150, 200,000 of growth a year and pushing up rents, it's a very manageable, healthy position where if you keep your LVR low, less than 40%, you're always be in a solid cash flow position. And then you just tap the equity, not only to reinvest, but to use that to supplement your lifestyle. Something to think about, food for thought. None of this is personal, general advice. It's just my story. It's just what we do. And prior to making any investment decision, you should seek independent legal financial tax advice. If you want help buying an investment property, hit us up. we can send you our details on our services, our roadmap for the years ahead to continue powering on. These days, it's looking like the best way to buy real estate is in either personal name or company structures. You can't do it in your super anymore. You can still buy in trust structures, but uh, looks like Labor has killed them. So if you want help, hit us up. We can point you in the direction if you need a mortgage broker or a tax accountant or solicitors, conveyancers. We've got everyone you need on board to help you do a property transaction. But when you engage us for building out your portfolio, which is a 10 to 20 year plan. So if you want help, get in touch today. Thanks for watching. Keep powering on.